Okay, so we have application of IFRS, that International Financial Reporting Standards. That one alone is 30 marks of the syllabus. We also have the preparation of financial statements for a group, that's the console. The various one, we have 25. And also, this one is talking about ratios, 15 marks. We also have specialized transactions, 15. And the last one is about the sustainability, ethical, and the contemporary issues. So I think we have syllables you can go through and read. So as you can see, the standards carry the highest marks. Okay, 30 out of the 100. So as you can see, question 2, the format, question 2 will be 20 marks of the standards, and also question 3A is 10 marks. And sometimes the consolidation, you need the knowledge of, let's say, at least 2 standards for you to be able to solve the question. So today, without wasting much time, I want us to start with PPE. Okay, that's the mother of asset standards. All right. So please, are you having a question regarding the discussion or anything? Please ask it before we restart the class itself. If you are good to go to, I can start.
Good to go.
I can't hear you. Come again.
I mean, I don't have any issue, so we can.
Okay. All right. I think they are quiet, so we are good to go. Okay. So we start with PPE, the definition and all that. That one is forever. So let's leave it out. As at now, I know you know what PPE is. Okay, they are tangible assets, right? So the definition they are here. So when you get the document, you can go to yourself. Now let's talk about the recognition. Okay, the recognition criteria. So we know in accounting, if you talk of to recognize something and also to measure the asset or the liability, we know what it means. Okay, because that one, I think most of us we did FR, so some of us too we did CR last diet and all that. So recognizing means you are capturing that particular item, whether PP or maybe it can be item of PP or maybe asset or liability or anything. Capturing it in what the financial statement, mostly the statement of financial position. Okay, so we know that the elements of the statement of financial position, they are 5. We also have the components to be 5. All right. So to recognize something, so the asset for the PP, we are saying that for the initial recognition, you can only recognize that PP only if it is probable. And if you say something is probable, it means it's what 60 to 90% certain. Okay, we are almost certain that that thing will happen. So it's probable that future economic benefits associated with the item will flow to the entity. Secondly, the cost of the item can be measured reliably. So you can reliably say that, oh, the cost of the item was 1 million Ghana cedis and all that. All right, so this one is not important. Let's go to the part that we need. Even this one, we are saying that with the initial recognition, measurement, initially you recognize it as what, or you measure it at its cost. And for corporate reporting and financial reporting, to get the cost of an asset, okay, you have to add certain things. Okay, we have some elements that can or you'll be required. Mostly that one is for FR. Okay, you'll be asked to find the cost of that asset. So first of all, we are seeing that the purchase price of that item. So that's the first one. After deducting the trade discounts. Okay, so we will solve a question on that. Import taxes and non-refundable purchase taxes. So sometimes if you import something from outside the country, then you'll be asked to pay some duties and also some import taxes. All those things are added to the cost of the asset or the cost of that item. Okay. And we also have directly attributable costs of bringing the asset to the location and condition necessary for it to be capable of operating in a manner intended by management. Okay, so the directly attributable costs, we have some examples there. So first of all, we have the cost of site preparation. You have to prepare the site for that particular project. Maybe you want to construct a facility or something, a warehouse. You have to prepare the site. Installation and what assembly cost. Sometimes you import plants or maybe machines. Okay, you have to hire professionals or experts to come and install and assembly those plants before you can use it in your production firm. Cost of employee benefits. So this time around, you can talk of the direct labor and all that. Pre-production testing. Now this one is okay. So I'll come to the cost, the items that cannot be added to the cost of the asset. So this pre-production testing. So we are seeing a cost of testing whether the asset is functioning properly. Okay, so you have to test whether that asset is what functioning properly before you can start your production. Okay, so per the standard, they are saying that assessing whether the technical and physical performance of the asset is such that it is capable of being used in the production or supply of goods or services. So when you get to examples, you get to know what I'm talking about. And borrowing costs in accordance to with IS 23. So when you're done with IS 16, subsequently we will tackle IS 23. So you understand the parts of borrowing costs here. Professional fees, okay. Sometimes for you to start a project, or maybe bring item of PP into its usable state and even the location intended by management, you need the help of professionals. Can be the legal, the architectures and all that. Okay. And also we have something we call dismantling cost. Okay, so sometimes you as a company, you are obliged to dismantle and remove the assets at the end of its useful life. Sometimes these industrial people and all that, and even the mining firms, sometimes before you start the process, okay, in the contract you are required at the end of your project, let's say after 20 years or maybe 15 years time, you have to dismantle the asset and remove it from where it was. Okay, if it's about land, the mining firms, you have to restore the land to original state. Okay, so that one will be in 10 years time. So that figure that will be given will be in future terms, future value. Let's say 10,000, you pay 10,000 in 10 years time, but we are calculating the cost currently. So what you do is what you discount it to present value, present terms, and we know the formula for finding the PV. Okay, when you are giving the future value, we have the discounting factor. You multiply with what the future value. Okay, and I think most of us to learn consolidation. Okay, so where we have the considerations, some of them you have to calculate the future value in present terms. Okay, that's the present value. And after that, you have to find the unwound discount or the finance cost. And that one, we said, is the discount that will be given in the question multiplied by the present value that you have determined. So that one too, we will have an example here and maybe we'll go through and all that. Okay. Now, the following items are exempted from the elements of the cost of what? PPE. So when you are calculating the cost of PPE, maybe you've been given question, okay, and you have a whole lot of costs, and you want to determine the cost of that particular asset. Now, what you have to do is that um, the following costs, you exclude them. So we have startup costs, okay, that's the cost of opening new facility. So sometimes after they are done building or something, they will call, they will have this ceremony to open the facility. Sometimes they will cut, I've forgotten the name. So that thing is not part of what the cost of the asset because already the building is in 8 usable states. So you can use it without the startup cost or without particular ceremony. Still, you can use the asset. So that's excluded from it. And also cost of doing business in new location. Let's say you are operating in Kaswa now, you are relocating to Accra itself. Okay, so that cost cannot be added to the of item of PP, or maybe that particular item in question. You cannot add that particular cost to the cost of that item. And also maybe you have a new plant installed, okay, assembled and installed, and you have to train staff before they can use it. The staff training cost cannot be added to the cost of that particular plant. Okay. Cost of introducing a new product or service. Sometimes you have to advertise, do promotional activities and all that. Those costs cannot be added. Okay. Setup and similar pre-production costs. Okay. Setup and similar pre-production costs. So this one, if you don't take care, you miss it with the pre-production testing here. Okay. Pre-production testing. All right. So I think that one, at the end of the day, I'll send the FR IAS 16, the document from the IFRS themselves, then you read it to understand what this setup and similar pre-production cost is. They didn't give example, and I don't know the example I'll give for you to understand. But when you have a question, you see that this one is pre-production testing. Sometimes they will write it pre-production testing, okay? And you also see the pre-production costs, okay? So this one cannot be added. Initial operating losses, when we are operating at a loss, that one cannot add it. Cost of opening ceremony, so that this one is similar to the startup cost and all that. So administration and other general overheads. So we've mentioned I think 1, 2, 3, 4. There are 6 or something, but this is not exhaustive. Okay, so if you have any costs as part of the question, and that particular cost, okay, that particular item is not part of these elements, it means you cannot capitalize or add to the cost of that as item. Now, if you are given a question and you have the cost above here and these costs, what you are going to do is that after adding the professional fees, borrowing costs, and all that to the cost of the item, you capitalize it in the statement of financial position. Those that are excluded from the cost of the asset will be expensed in the P&L, because that one is a revenue expenditure. So that particular year, you will send it towards the P&L. You send it to the P&L. All right. So please, mostly this type of questions, they are for FR and those writing FR, but for us to get the knowledge, okay? Because our own start from the revaluation and all that. The FR will be examined on these things. Okay. So please, anyone having a question for me before we solve 1 or 2 questions so that we move on with this element of cost? Hello.
No question from.
Same, please.
Okay, so let's move on. So this is quite simple. I will not solve this because you solve some detailed one B. Okay, so Dynamic Enterprise installing a new plant at its production facility. It has incurred the following costs. Okay, so this one will be added. That's the cost of the plant. That's the cost of the item, the purchase price. Initial delivering and handling cost is part. Okay, the site preparation is part. All right. The consultant is what? Professional fees. Okay, so that one is part. Interest charges paid to supplier of plant for deferred credit. This one is not part. it's like you are being fined, okay, or you are paying penalty for deferring your credit. Maybe the days, okay, that you were supposed to pay, maybe the credit days or something were overdue, so you've been charged extra amounts, okay. So that one can be termed as penalty or something. That one is not part of the cost, so that one cannot add it. Estimated dismantling costs to be incurred after 10 years. So this one you add it. All right. Then operation losses before commercial production. This one too is not part. So you add them, whatever you get will be the cost of the assets. And that's what you are going to capitalize. Okay. That's what you are going to capitalize. All right. So please can we move on? The estimated dismantling costs. This one is in future value, but because the question didn't give us any rate or something, that's why we didn't discount it to present value. Let's look at the illustration 2. Okay, so with the illustration 2, okay. So with the illustration 2, you can see that they gave us what? Discount rate of 5%. So what you are going to do is what? Discount it to what? Present value, the present terms, okay? So it's the same question, just that this one they've added the discounts. Okay, so what you are going to do is that the formula you can use is what? Is 600,000, then multiply by discount factor. The one we know is what? 1/1 plus the rate. Okay, raised to the power n. N is the number of years, so 10. So this one will give you the present value. All right, so someone should give me the present value. Hello, I'm waiting on. I want the figure.
Please, we are calculating. We'll get back to you shortly. $3,683.47.95.
So let's make it 368. So this is what you add to your cost, not the 600. This one will be the future value after 10 years. And if you discount it to now, I mean, you want it now, that one you pay 368. So this is the present value. So this is the amount you are going to add to your cost, not 600. Okay. So we know the items you are going to add and the items you are going to exclude. Okay. So that's how we calculate it. I'm not writing because this one is just simple. I'll start solving with the difficult ones and you appreciate the concept well. All right. So the unwound discount or the finance cost I was saying, the rate is 5%. To find the finance cost or the unwound discount, this one will be added to the P&L. It will be the 5%, okay, on the present value that you've determined on the 368. Okay, so to find the unwound discount or the finance cost, and this one will be expensed in the P&L. Okay, so 5% of 368 will give you what?
That's 18,417.
You said
18,417.
16.
18, 1 8.
18.
417.
You added the 3 zeros. Just calculate it for me like this. 5% times 18.7.
4.
4.
Yes, please.
So But this one is not needed here. You do it well when we are doing consolidation, so you don't worry. So this one, this 18.4, you send it to the P&L as finance cost, okay, as finance cost. And at the end of the day, when you are doing the balance sheet, that is statement of financial position, you add this 18.4 to the present value of 368 as non-current liability. Okay, you don't worry if you don't understand it here. I will explain it better when we get to the consolidation. Okay, the consolidation. Okay, so let's move on to the question, the illustration 3. So with this one, I will try and solve. Okay, illustration 3. Okay, so please someone should read for me.
Okay, illustration 3. An entity started construction on a building for its own use on 1st April 2013 and incurred the following costs. We have the purchase price of land, land registration fees, legal fees, site preparation and clearance, materials, labor. That's for the period 1st April 2013 to 1st July 2014. Architect fees and general overheads. The following information is relevant. 1. Material costs were greater than anticipated. On investigation, it was found that materials costing 10 million Ghana cedis had been spoiled and therefore wasted, and a further 50 million Ghana cedis was incurred as a result of faulty design work. 2. As a result of this problem, work on the building ceased for a fortnight during October 2013, and it is estimated that approximately 9 million Ghana cedis of the labor cost relates to this period. The building was completed on 1st July 2014 and occupied on 1st September 2014. You are required to calculate the cost of the building that will be included in tangible non-current additions.
All right, thank you. So let's start from the top. Okay. Okay, so we have the purchase price. That one is 250,000. We have land registration fees. Okay, so that one will be added. Legal fees. Okay, that one is part of the professional fees. Legal fees, architect fees, they are all part. So legal. That one is 10,000. The same as what architect. They are all professional fees. So that one is 20,000. Okay. So now we've treated this one. Okay, so the site preparation and clearance tour is part. So that one is 18,000. Now the general overheads is not part. Okay. General overheads, 30,000 is not part. Okay, that one is excluded. So this one is not part. Now let's talk about materials and labor. We have notes here. So the materials, 100,000. Okay. But let's look at the notes. They said that on investigation, it was found that materials costing 10 million had been spoiled. So that one cannot be added to the cost of the assets. Okay, but that one had been spoiled. So we didn't use it at all. So that one is out. So minus 10,000. And also, therefore, a further 15 million was incurred as a result of what? Faulty design work. Now, the thing, we're having fault with it. That means we didn't use it in what? The work or the project itself. So that one too will be taken out. So you are not going to pick the 100,000. You take out the spoiled ones and the faulty ones. Okay, so in total we have 25 million. So you take it out from the 100 million, then you get 75. Okay, let's talk about labor. Okay, now the labor, 1st April 2013 to 1st July 2014. So how many periods do you have here? I think is it 1 year, 2 months, or is it 14 months? Okay. So as a result of this problem, because of the faulty materials and the spoiled ones, work on the building ceased for a fortnight during October 2013. A fortnight means what? 2 weeks. Okay, and it is estimated that approximately 9 million of the labor costs relate to this period. The building was completed on what? 1st July 2014 and occupied on what? 1st September. Now, one thing about asset is that we don't care about the date it was put to use. Okay, all we want is the date that the asset was ready for its intended use. Okay, so all what we care is about 1st July. So this 9 million has been taken out of what? The labor cost, 150,000 here. Why? Because of the problem here. The faulty ones and the wasted ones, they ceased for what? 2 weeks. And in that 2 weeks, the amount that the company incurred was what? 9 million. And that time, they didn't work on the project. Okay, because they said they ceased for a fortnight, meaning during those days they were not working. Okay, so you have to take it out. Okay, so that one too will be 150,000 divided by minus 9,000. Then you get 141. Okay, so this will be the cost of the assets. So please, someone should add it for us.
519,000.
Okay, so please, if you're having a question, you can bring it out. Or I think this one is quite simple. Okay, this one is quite simple. All right. Okay, so let's read this one. Hello, the one who read for us, kindly help us here.
Okay, so illustration 4. On January 1st, 2016, Jinyame PLC acquired production equipment in the amount of 250,000. The following further costs were incurred: delivery, installment, general administration cost of an indirect nature. So, okay, the installation and setup period took 3 months, and a further amount of 21,000 cedis was spent on cost directly related to bringing the asset to its working condition. The equipment was ready for use on 1st April 2016. Monthly managerial reports indicated that for the first 5 months, the production quantities from this equipment resulted in an initial operating loss of 15,000 cedis because of small quantities produced. The months thereafter showed much more positive results. The equipment has an estimated useful life of 14 years and a residual value of 18,000 cedis estimated. Can you please scroll up? 18,000 cedis. Okay, 18,000 Ghana cedis. Estimated dismantling costs amounts to 12,500 cedis. A relevant annual discount rate to use in any discounting is 10%. What is the cost of the asset, and what are the annual charges in the statement of profit or loss relating to the consumption of the economic benefit embodied in the assets? Assuming December. Okay.
Thank you. So you start with what? The purchase price. Okay. So let's see. So they acquired the production equipment for what? 250,000. So let's say production equipment. So that one is for 250. Okay. So we have to add delivery. 18,000. Installation. You know installation is parts. That one is 24,500. General administration. Okay, so we know this one is out. Okay, so the installation and setup period took 3 months, and a further amount of 21,000 was spent on costs. Sorry, was spent on costs directly related to bringing the asset to its working condition. So the installation, apart from the 24,000, there was what? Extra costs on what? Installation. So let's say extra installation costs. So that one was 21,000. Okay, the equipment was ready for use on 1st April. So take note, the equipment was ready for use on 1st April 2016. Okay. Monthly managerial reports indicated that the first 5 months, the production quantities from this equipment resulted in an initial operating loss of 15,000. So the moment you see initial operating loss, that one is not part. So take note. The months thereafter show much more positive results. The equipment has an estimated useful life of 14 years and a residual value of 18,000. So if you have this, just know that you'll be calculating depreciation. Although you've not started depreciation, but you calculate it as this one is not new to us. Then dismantling costs. Okay, that one is what? 12,500. The rate to use in the discounting is what? 10%. So dismantling costs. So this is how you are going to calculate it. Okay. Now, the future value is what? 12,500 times the discounting factor. How do you do that? Okay. Okay. You let me do the simple one. Just do 1 plus 10% raised to the power negative
10.
They said that the
14.
useful life of the asset is what? 14. So this one, or you can do the one that is common. 1 plus 10% raised to the power 14. They will all give you the same answers. Okay. So please, who is giving us the answer? So that one will give us the costs. So adding everything, that's the cost of the.
Okay. 3291.64.
3291.
91.64. Should please
So
confirm.
let's run it to 92.
Confirm.
So
Okay.
let's add it. Let's add it. That will give you the cost of the assets.
That's 316
791.
791. Yes, 164.
Okay.
So it's fine.
Point.
792 is
It's okay. It's
Okay.
okay. Yeah.
Okay. So because of the extra information we have here, the residual value, useful life, and all that, they are just drawing our attention to solve a depreciation or calculate the depreciation, because they said that, and what are the annual charges? Okay, that means depreciation. All right. So although we've not started depreciation as a subtopic, but I want us to use this particular opportunity to introduce depreciation. So depreciation is the cost of the assets, okay, minus the residual value, if any, divided by useful life. So this is what you mostly use, okay, useful life of the assets. All right. Now the costs as determined is 316,792. Residual value per this information is 18,000. Then the useful life of the asset is what? Where is it? 14.
14.
Yes. So please, what is the
10
amount?
years. That's 21342.
Oh, sorry. I forgot this. So they said assuming year end to be 31st December, meaning the reporting date is what? 31st December 2016, because the year we are dealing with is 2016. Now, the equipment was ready for use. So that is when you start calculating depreciation. So I told you that we care about the date it was ready for use, not about the date it was put to use. So it was ready for use on 1st April. To the reporting date is what? 31st December 2016. How many months do you have here?
9 months.
9 months. So it will be times 9/12. You cannot calculate for the full year because it was not ready as at March. It was ready on what? 1st April. So 9/12. So please, what are we having?
16,007.
007. Okay, so if you are asked to prepare extracts, okay, so this one will be going to the P&L as depreciation. Then when you get to the statement of financial position, you let me do it. So you P&L extracts, okay, yes, the extracts. So we have depreciation, and as you know, depreciation is what? Negative figure. So then SOFP extracts. Now we have non-current assets. We have what? Equipment, production equipment. You value it what, or we measure it at what? The carrying amount or the carrying value. So that one is the cost of the asset. That was 316,792 minus the depreciation. If we have just 1 year, subtract that particular year. But if we have let's say 2 years, 3 years, you subtract the accumulated depreciation. Okay, so we are going to depreciation, you understand. All right, so please, what's the answer for this one?
3007
7.
785.
All right, thank you. So this is what you do. As I said, this one is just straightforward. Okay, so let's look at this one. All right, so exchange of assets. Okay. Now, this is where maybe a company want to acquire an asset, okay, but they want to use the asset that they have, okay, so let's say you can use the term swapping, okay. The normal times we have funds you want to swap for an upgrade, okay. The same thing, maybe a company is having land, okay, then they will exchange it for a plant or maybe they have certain plant, they will exchange it for what? Land. Okay, so an asset may be acquired in exchange for another asset. How do we measure that particular asset? Okay, so we are saying that the cost of such an asset is measured at its fair value. Okay, so this fair value thing is a whole standard on its own because it cuts across almost the standards. All right. So we are saying that you use the fair value unless that particular transaction lacks commercial substance, meaning you have no active market or you cannot use any particular price as benchmark or something. The fair value of neither the asset received nor the fair value of the asset given up is reliably measured, okay, or measurable. So this one too, you cannot measure their fair value, whether the assets given up or the one you want to receive. That one you use the cost, all right? You use the cost. So let's see the order that you use. So first of all, you use the fair value of the asset given up. So the one you are, let's say if you have plants and you want to exchange to acquire land, the fair value of the plant is what you are going to use to measure the land that you are acquiring. So let's say a company A is having plants. Okay, they want to acquire a land that belongs to company B. Now the plants that company A will give up, okay, in exchange for the plant from company B, we are going to measure the asset that belongs to company B, that's land or is it plant. Let's use this particular example illustration, okay, because maybe I might confuse you. So first of all, we are saying that the order should be the fair value of the asset given up. If you cannot determine that one reliably, you use the fair value of the asset received. If that one too cannot be determined reliably, then you use the carrying amount of the asset given up. That's the last thing you do, because that one there, it can be calculated or it can be determined. Okay, that one is the cost of the asset given up less its accumulated depreciation. That one give you the carrying amount. So first of all, the fair value of the asset given up, the one you are giving up to acquire another asset. 2, if you don't have the fair value of the asset given up, you use the fair value of the asset you are receiving. 3, the carrying amount of the asset given up. Okay, that's the last thing you use. And you are saying that in the situations where you use cash, you pay cash. Okay, you pay cash as additional consideration. Okay, let's say you are swapping phone. Okay, so you give up your phone, then you add an amount to that phone to, acquire another phone or another asset. That money you are adding will be added to the fair value of the asset that you want to receive. And that one will be the amount you are going to recognize in the statement of financial position. So let's look at this particular example. Maybe the talking might be confusing, but let's see. Jinyami Enterprise and exchanges a motor vehicle with a carrying amount of 21 million. Okay, with a carrying amount of 21 million and a fair value of 26 million. Okay, for a plant. So they are giving up motor vehicle, car. They are giving up motor vehicle to acquire a plant. In addition, Jinyami also paid a cash amount of 1.5 million. Now, in your books, you are measuring the assets at what? 21 million. But the fair value that you are using is what? 26 million. Meaning already you've gotten fair valuation gain. Okay, because in your books it's 21 million, but the fair valuation says what? 26. So that difference of 5 becomes gain to that particular company, the Ginyami in this case. Okay. Ginyami paid an amount of cash, okay, 1.5 million. And this is how you are going to record it. Okay, so let's look at the initial recognition. So that one will be fair value of asset given up. So we are saying the first order to use is the fair value of the asset given up. So we have millions here. Okay, so the fair value of asset given up is 26 million. Okay, then the extra cash paid will be added. That one is 1.5. So in all, initial recognition or the costs of that assets will be 27.5. 27.5. So this one will be the price of the plant that you are acquiring. Okay, you are acquiring plants, but you give up motor vehicle. And that motor vehicle, the fair value was 26 million. You paid extra cash of 1.5 million. In all, the plant that you are acquiring will be measured at what? 27.5 million. So the double entry you are going to do is what? You are going to debit the plant. Okay, debit the plant. And the amount will be 27.5. Let's see how the credit entry will be. Disposal of assets, you come to that side. Okay, well, let me explain it. If you acquire plant, this one is basics, the base in accounting. Debit the receiver, credit what the giver. So if you are acquiring plant, if you use cash to buy, let's say, motor vehicle, you are going to debit the motor vehicle, you credit cash because motor vehicle is coming in, cash is going out. So the same thing applies to this one. The plant is coming into the business, so we are debiting plant because we are adding that one to our books. In other words, plant is an asset, and we know asset is having what? A debit balance. And you are having an asset and you want to increase it, you add it to what? The debit side. The opposite way is when you're having an asset and you want to reduce it. In this case, the motor vehicle, we gave it up to acquire the plant, meaning it's not with us anymore. So you have to take it out from what? Your books. And in accounting terms, you are saying you have to de-recognize it because recognition means you are capturing the information in your statement of financial position. So if you are de-recognizing it, it means you have to take it out from your books. And asset is having a debit balance. So if you want to reduce that particular asset or remove it from your books, you credit motor vehicle. And one will ask, what amount are you going to use here? Over here, you're not going to use the fair value. No, you are going to use the amount in your books because the current amount in your books said the asset was 21 million. So you credit 21 million. You credit 21 million. Now you paid cash. Cash is going out. You paid extra cash of 1.5. Credit the giver, debit the receiver. Here, cash is the one giving. So you have to credit cash. Also 1.5. Now, the extra 5 million that I said, because in the current amount, it was 21 million in the books. In your books, you said the assets is worth 21 million. But the fair value says is what? 26 million. So this is the fair value. So the difference is what? 5 million. And that 5 million will be termed as what? Fair valuation gain. So this fair valuation gain will be credited to the P&L. So you credit this to the P&L account. Okay, so this one will be gain. So this one to 5. So if you add 21 plus 5 plus 1.5, you are going to get the 27.5. Okay. We are crediting P&L because in P&L, if you credit it, it means you are adding something to it. So normally we credit the incomes, the revenues, and the gains and all that. If you debit it, it means you are reducing it or you are deducting something from it. So mostly we deduct the expenses, the losses, and all that. So please, up to this point, you have any question? Hello. Is the exchange of assets okay?
Yes, from my end.
And okay.
OJ,
Yeah, I'm okay.
Okay, so let's go to
Philip.
the illustrations 6. I'm going for it. I have to divide it because it's taking a whole lot of space. Okay, but it's fine. Okay, so illustration 6. Dynamic Enterprise Exchange a forklift track. So the one giving up is what? Forklift track. So you are giving this one up, giving up for a motor vehicle. Okay, so this is what you are acquiring. So you are acquiring motor vehicle. So you want to swap your forklift for what? Motor vehicle. That is what literally it means. On the date of the exchange, the forklift has a carrying amount of 20,000. So in your books, the forklift is what? 20,000. But the fair value says otherwise. The fair value is saying that it's what? 15,000. So let's look at something here. Carrying amount is saying is 20,000. Fair value is saying 15,000. So going forward, are you making loss or gain on this particular transaction or exchange of assets?
Yeah, loss.
Loss of 5,000. So you get to the entry. In addition to the giving up forklift, Jinyami also paid extra cash of what? 3,000. So this is what you are going to do. Okay. So first of all, we are going to measure motor vehicle, the one we are acquiring. One, at the fair value of the asset given up. Okay. So the fair value of forklift was 15,000. Okay. And the cash that they paid is what? 3,000. Okay. So initially, the costs of motor vehicle will be recognized at an amount of what? 18,000. Now, the information, the carrying amount, we said that the cost was 60,000, the cost of that particular forklift. And accumulated depreciation, the moment you see accumulated depreciation, it means the depreciation is not just for 1 year. We have maybe number of years. We don't know. It can be 2 years, 3 years, 4 years. So that one is 40,000. So if you take cost minus accumulated depreciation, you have carrying amount of 20,000. Okay. So what you are going to do is now you've been able to determine the cost of the motor vehicle. So let's look at the double entry for this particular asset. Let's look at double entry for this particular asset. Okay, so can we try? Can we try? Because it's like I'm talking too much.
Okay, let me try. So we debit motor vehicle with an amount of 18,000.
Yes,
Then
because it's coming in.
yes, because it's coming in. Then we credit the forklift with our carrying value, a carrying amount of 20,000. So when we credit our forklifts with 20,000, we paid cash of 3,000, so our cash to also reduce. So we credit cash of 3,000. Then I think, oh, I've forgotten. We'll debit our P&L
Right.
with the loss, a loss of 5,000.
Yeah.
Yes.
So if you add it, it's 23,000. Yes. One can also say that, oh, there's accumulated depreciation. Okay. Hold on, I'm coming in. Next.
Recording in progress. Recording in progress.
Okay, so let's move on to subsequent expenditure. So we are getting to the advanced one. So please let's.
You were about to say something about the depreciation when you were called.
Okay, so I was saying that you can debit the accumulated depreciation of 40,000. Okay, and also you credit the forklift, the costs. Okay, but you can also do it this way. It's the same thing. Okay, it's the same thing.
Okay.
That's why I skipped it. All right, so
All right.
subsequent expenditure. Subsequent expenditure. So maybe you're having motor vehicle. Okay, you're having motor vehicle. So we've already determined the cost and everything. Let me use plant. You've added the installation cost, the legal fees, and all that, the site operation and all that to determine the cost of that plant. Let's say in 3 years' time, after buying the assets, you performed a spend or you incur cost on that particular plant. And we are saying that normally the cost that you incur on the plant should be what? Expensed. That means is what? Revenue expenditure. It should be credited to a P&L. That's what we call revenue expenditure. But sometimes those expenses or those maintenance you perform on that particular plant must be capitalized. And we are having a criteria for recognizing or capitalizing such expenditures. Okay, so in practice, this means that expenditure is capitalized if it enhances the economic benefits provided the assets. That economic benefit could be extending the asset's life, expansion or increasing the productivity of assets, reduction in costs. So let's say you've acquired plant, okay, and it was producing in 3 years' time. The production volume reduced because maybe there was fault with it and all that. So after 4 years, it was producing just, let's say, 500 units. So you perform maintenance on it or you incur expenditure on that particular plant, and the production volume increased from 500 to 800 or maybe 2,000, twice of it. It means that expenses you incurred on that particular asset has improved, okay, or has increased the productivity of that particular asset. If that's the case, that particular expenditure you incurred or the cost that you incurred on that particular maintenance can be added to the cost of the asset, or it can be capitalized. That's the accounting term. Or if that particular expenditure relates to an overhaul or require major inspection of the assets, we are saying that the cost associated with this should be capitalized and depreciated over the time until the next overhaul or safety inspection. Okay, so all these are just readings. You will pick a question and you understand or if the expenditure is replacing a component of a complex asset. One will ask, what is a complex asset? We are saying that a complex asset is an asset that is made up of a number of components, which each component is depreciated at different rates. Okay, so always we use aircraft as an example, because we are saying that the aircraft itself, the whole aircraft cannot be considered as one asset, so that you depreciate it over one useful life, or maybe one rate or a single rate. No, because we said that the aircraft itself comprised of the body. Okay, we have the engine and we also have the interior, and all these three components have, let's say, different useful life, and it can be depreciated at what different rates. Okay, so all other subsequent expenditure apart from these three should be recognized in the statement of profit and loss. Okay, it should be expensed. So you will take example and you look at it. So illustration 7, a piece of plant has an annual service cost. So annual service cost is like maintenance. Every year I have to what come and check for the fault and all that. So in some companies, they have contracts with the those experts in the air conditioning and all that. So every year they will come and service it and all that, and the company will add it to their cost. That one will be captured as what revenue expenditure. So it means it will be expensed in the P&L. So this annual cost of 10,000. During the most recent service, it was decided to replace part of the engineering, meaning that it will work faster and produce more units of product per hour. So we are saying that the cost of replacement parts is 20,000. They want to replace part of that particular plant, or maybe, yes, that particular plant. And replacing it will increase the productivity of that plant. But the 10,000 is just annual service cost. So the answer is that the 10,000 should be what? Expense in the P&L every year. That one is revenue expenditure. Because that one is just servicing. You are servicing the asset, and it adds nothing to the property or the plant. But the 20,000, the replacement, will enhance future economic benefits, because it's going to increase the productivity of what? The plant. So that 20,000 can be what? Capitalized. Now, what it means is that if you have, let's say, a subsequent expenditure that meets the capitalization criteria, let's say the replacement, okay, 20,000 happening in 3 years' time, you have to calculate the depreciation, okay, to that 3 years. Let's say we are in 2017, we bought the asset in 2017. And the capitalization, this one, the replacement happened in, let's say, 2020. You have to calculate depreciation for 2017 as a whole, depreciation for 2018, depreciation for 2019. Then if the replacement happened at the year end, or the end of 2020, you have to calculate depreciation of the whole 2020 before you can add the 20,000 to the carrying amount as at that date. You cannot just add the 20,000 to the cost of the asset in 2017. No, because the subsequent expenditure happened in 2020. And you have to calculate the carrying amount. You have to determine the carrying amount as at the date that the subsequent expenditure occurred. Okay, so we are going to take illustration on that, and you appreciate what I was trying to explain. Okay, so let's read this illustration 8. So we are saying that Ginyame Enterprise owns a factory at a cost of 1 million. So the cost of association 8. So the cost of the asset was 1 million. Okay, the cost of the asset was 1 million. As at 1st January 2017, it was 1 million. The factory is depreciated at a rate of 12.5%. It was depreciated at a rate of what? 12.5%. As at 30th June 2018, the entity completed an extension of the factory at a cost of 300,000. So this is a subsequent expenditure. And the extension increased the production capacity. So it increased the productivity of that particular factory and extended the useful life. So this one, it's increased two things. One, it increased the productivity. Two, it also extended the useful life of the asset by 2.5 years. You see, they've given you 2.5 years. Now, initially, one will ask, how will I know the useful life of the asset as at the time we acquired the assets? Now, this one is a clue. If you have a rate, depreciation rates, and you don't know the useful life in the question, just do this 100 divided by that depreciation rate. So here it will be 12.5% or 12.5. That one will give you the useful life of the assets. Again, if you have depreciation rates and you want to determine the useful life of the asset, but that one was not given in the question, simply do this 100 divided by the depreciation rate provided in the question. So this one, what will be the answer? 100 divided by 12.5.
Eight.
8 years. Okay, so 8 years. So that is the useful life of the asset as at what? The 1st January 2017. Now, determine the carrying amount of the factory as at 31st December 2018. So they bought the asset on 1st January 2017. Okay. The subsequent expenditure happened on 30th June 2018. He said, come again. Okay. So the whole of 2017, you are going to calculate depreciation. So you calculate depreciation for the whole of 2017. Now, when we get to 2018, it was 30th June 2018. So you calculate extra 6 months. So in 2018 too, we are going to calculate depreciation from 1st January 18 to 30th June 18. Okay. And from here, we also calculate the depreciation from the 30th June. In this case, so we start from 1st July 2018 to the end, that's 31st December 2018. Okay. All right. So let's start the actual workings. All right. So the cost of the factory was 1 million. Okay. Now we calculate depreciation. The depreciation that we are calculating here is for the whole of 2017. So that one, you have two ways. Now you've determined the useful life of the assets. I even gave hint here. You are saying that total useful life is determined 100% over the depreciation rate So this one is a clue. Okay, so here you can just do the rate that was given, 12.5% times the 1 million. That's the cost. Or let me do this because you need the years. The cost was 1 million. Or the 1 million divided by the 8 years. There was no residual value, so we can also do this. So please, what is the depreciation for 2017? One can use this formula, one also can use this one.
125,000.
125,000. So what will be the current amount as at 31st December 2017? The current amount. Current amount will be what?
875.
Okay. Now, the extension of a factory at a cost of 300,000 happened on the 30th of June. But the current amount we are having here is 31st December 2017. Now, this one, we know that the closing balance of 2017 becomes the opening balance of 2018. So this one, the 875, can also be considered as what? The opening balance for 2018, because the current amount here can be used as what? Current amount for 1st January 2018, the same 875, because closing balance of 2017 will become the opening balance of 2018. Okay, but the subsequent expenditure didn't happen on the first day of what? That 2018. It happened at the end of June. So we have to calculate the depreciation for that 6 months, okay, from 1st January 2018 to the 30th June 2018, that the subsequent expenditure happened or occurred. Okay, so we will calculate another depreciation. All right, this time around it can be 1 million over 8 years times 6/12. Okay, because from January to June is 6 months. Or the 12.5% times the 1 million. This one also times the 6/12. So please, what's the depreciation? Hello? Hello?
62,500.
Yeah, confirm.
62,500.
Yeah.
Okay. So the carrying amount as at the 30th June 2018 was subtract it for me, 875 minus 62,500.
812,500.
812,500. Now, this was the date that the extension happened, okay, 30th June. So we can simply add the subsequent expenditure. $300,000. So now the new cost of the assets or the revised cost will be
$111,2500. 2500.
okay. So this one is still as at 30th June 2018. But the question said we should determine the current amount of the factory as at 31st December 2018. So now we have to calculate depreciation from 1st July 2018 to 31st December 2018. So we calculate another depreciation. Okay, that one is from the 1st of July to 31st December 2018. And that one will not be the original cost again, the cost of 1 million. No, this time around, they've revised it, or they did extension. So now the cost you are going to use is this 112. It's 111, sorry. 500. Now, this is the cost that you are going to use. Now, the reason why I determined the years is because of this. Because they said that after the subsequent expenditure, it extended the useful life of the assets by 2.5 years. Let's do simple mathematics here. Initially, the assets useful life was what? 8 years. Because we did 100 over 12.5, you got 8. Now, how many years have you consumed as at 30th June 2018? Who can tell me? How many years have you consumed as at 30th June? We bought the asset on 1st January 2017. Now, we are at 30th June 2018. How many years have you consumed? You need this in revaluation. So please.
That's is it 1.5 years?
Someone is saying 1.5. Please, who is having alternative answer, or who is supporting this answer? Hello?
1.5.
1.5, yes. Because the whole of December, the whole of 2017 was 1 year. And as at 30th June 2018, also half year. So that one is 1.5 years. So we've consumed 1.5. Okay. So as at this time, we are having 6.5 years left. You're having 6.5 years left. Now we are saying that the subsequent expenditure of 300,000 extended the useful life by 2.5 years. So in accounting, let's be mindful of by and to. Okay, so it has extended the useful life by 2.5 years. It means as at 30th June 2018, the extension, okay, was 2.5 years. So we are having 6.5 years left at 30th June 2018. The subsequent expenditure increased the useful life of the asset from 6.5 to what? What will be the answer? Let me do this so that it will not confuse you guys.
That's 9.
You said 9
years.
years. So now the useful life of the asset has extended to 9 years. Okay, so the number of years you are going to use will be 9 years. Here you don't use any rate here. That's why I didn't use only the rate. Okay, we determine the useful life. So this one too is not the full year, 6 months, because from July to December is 6 months. So 6 over 12. So please, what's the answer?
I
That's
had
61805 806.
Yes.
So the current amount as at 31st December 2018 will be
1050694.
Confirm.
So please, we are done with this particular question. Who doesn't understand? Any question for me? If you understand this concept, revaluation will be simple for you. Please. Any question up to this point? Okay, so we can move on. So with this same question, if you were asked to prepare the extracts for 2018 alone, you are going to have two depreciations, okay? Because one was the previous one before the subsequent expenditure, the depreciation we calculated. So that one was 2018. Where is it? Where is the depreciation? That's the 62,500. Okay, 62,500, because that was the half of the year, and the other half is what, 61,806. So if you are preparing extract for 2018 alone, the depreciation will be 62,500 plus 61,806, because we have January to June, different calculation, and also July to December, different one. So please, I hope you understand. Can we move on? Can you move on? Hello.
Yes, please.
Yeah.
Okay. So please, someone should read the illustration 9 for me.
Okay, illustration 9. On 1st October 2005, Daring acquired a machine under the following terms: manufacturer's base price, trade discounts into brackets applying to base price only, that's 20%. Early settlement discounts taken, that's on the payable amount of the base cost only, that's 5%. Then we have freight charges, electrical installation costs, staff training in use of machine, pre-production testing, purchase of a 3-year maintenance contract, estimated residual values. Then we have the hours, we have the estimated life in machine hours, hours used, that's as at year end 30th September 2006. Okay. Then year end 30th September 2007, year end 30th September 2008. We are to see below. On 1st October 2007, Daring decided to upgrade the machine by adding new components at a cost of 200,000. The upgrade led to a reduction in the production time per unit of the goods being manufactured using the machine. The upgrade also increased the estimated remaining life of the machine at 1st October 2007 to 4,500 machine hours, and its estimated residual value was revised to 40,000 Ghana cedis required. Prepare extracts from the income statements and statements of financial position for the above machine for each of the 3 years to 30th September 2008.
Okay, so this one was a full package. All right. So we have to determine the cost. Yeah, or someone talking. Hello. Okay. So we have to determine the cost of the assets. Okay. So that's what we want to do. So let's look at this. So first one, you add the cost base, that's the manufacturer's price, that's the cost of that particular asset. That one was 1 million and what, 50,000. Now, when we were reading, he said that the base or the cost of that particular asset less any discount. And the discount that you are going to deduct is trade discounts. That's what you can deduct from the cost of the assets. This early settlement discount will be taken to P&L because that one is like that one is a revenue one. Okay, that one you cannot capitalize it. The one you can capitalize or you can deduct from the base price is what the trade discount. But that's what the standard says. All right. So you deduct your trade discount from it. And we said the trade discount is 20% applying to the base price only. So 20% of this. Okay, so 20% of the base price. That is a 105, 123. All right, so you deduct
210,000.
210. Okay, so what is the net?
So that's 84,000.
84.
840.
840. Okay, so we've treated this one. Now let's look at the following ones. Freight charges. So this one you add it. Okay, so this one is 30,000. I also have electrical installation costs. That one is 40,000. Then the 22,000 is for what? Pre-product. Is it? Oh, no. The electrical installation cost is 28,000. So this staff training in use. Okay, in use of this machine is not part per the standard. You cannot add it. Okay, because if you are training your staff to use the machine, that's not part the element of cost. Because that one, the asset is already in its usable state or its usable condition. All right, the pre-production testing is part. That one is 22,000. Okay. Estimated residual value, we use it to calculate our depreciation. Purchase of a 3-year maintenance contract. Okay, this one is not subsequent expenditure. No, this one is annually. Every year you have to perform this particular maintenance. So as I said, in various institutions, they have contracts with these experts who take care of air conditioning. So every year they will come and perform this maintenance. So this cost cannot be capitalized. This cost will be expensed. So in the 3 years, the whole contract was what, 60,000. So if we are preparing our P&L extracts, it will be 60,000 divided by 3 years. So every year you allocate 20,000 to it. That's when we get a P&L extra. So for now, let's leave it out. Residual value too will be used to calculate depreciation. So this one too is out. All right. So this will be the cost of the asset, initial cost. So please, what is the net? If you don't understand anything, just prompt me before we move very fast. Okay.
920,000.
920,000. Now, if you want to calculate the depreciation based on the formula I gave you earlier, I said the cost minus residual value. So we have residual value of 20,000. So we take it out before we will get the amount we will use for depreciation. So residual value. So that one will be 20,000. So the amount we are going to use for depreciation or the depreciable amount will be what? 900,000. We are doing this because the depreciation, we are going to calculate it in different styles. Okay. If we have it as a unique way, if you are using rate or anything, that one, you could have done this 920,000 minus the 20,000 residual over the useful life. But here we don't have useful life. Okay. We don't have useful life. Okay. We don't have useful life. Okay. So let's move on. So this is what you are going to, this is the amount you are going to use for depreciation. But this is the initial cost of that asset, the 920,000. Okay. Now, this one we are going to use hours. Okay. Estimated life in machine hours. So this one, the estimated life this time is not in useful. This one is not in years. This one is in hours, machine hours. Now, how do we determine depreciations? So we have to determine depreciation for 2006, 2007, and 2008. Now, in 2006, the estimated useful life in machine hours was 1,002. Okay, was 1,002. Before that, let me do this. Let me calculate cost per machine hour. Cost per machine hour. Now, the depreciable amount is what? 900,000. Then the total machine hours is what? 6,000. So the cost per machine hour will be 150 cedis per machine hour. Okay. We are going to use this to determine the depreciation charge for 2006 and 2007. Okay. Please, is it clear now? Is it clear for everyone here?
Please
Hello.
say that again. Yeah.
This one, we are using hours. So we've already determined our depreciable amount. That is the 900,000 here. Now we cannot just use this 900,000 multiplied by the 1,002 hours here to get our depreciation charge for 2006. No, we have to convert something. And what is that? That is the cost per hour. We have to determine the cost per machine hour. And the depreciable amount is 900,000. The total useful life in that machine is what? 6,000 hours. So just divide 900,000 by what? 6,000 hours. And it will give you 150 cedis per machine hour. So every hour you are incurring what? 150 cedis of what? Depreciation. So the depreciation charge per hour is 150 cedis. Now, when it comes to 2006, the depreciation charge will be the total hours used in 2006. That's the 1,002 hours. Multiplied by per hour, 150 cedis. 2007, it will be 1,800 multiplied by 150 cedis per hour. When we get to 2007, we will do extra work because they said see below. So for now, let's focus on 2006 and 2007. So please, do you understand up to this point?
Yes.
Hello. The person who said I should go over, is it okay?
Yes, please.
Okay. So now the depreciation for 2006 will be per machine hour 150 cedis times the number of machine hours in 2006. The number of machine hours, okay, the hours used year ended 30th September is what? 1,002 hours. So please, what will be the total or the annual charge for 2006? This one is an alternative way of what? Calculating depreciation, but this time around we don't normally use it. Okay, so you will be giving rates, estimated useful life, and all that. But this one, as you can see, the years is old, is very old question. Okay, so you don't get confused. All right. So please, what do you have? Is it 180?
180,000.
Okay.
Yeah, 180.
Let's go to 2007. So that one to 150 cedis per machine hour multiplied by the number of hours used was what? 1,008 hours. So this one too, what do you have?
270,000.
$270.
Yeah.
Now the year end is what? 30th September. Every year. That's the accounting year. It ends on what? 30th September. Every year. On 1st October 2007, Darren decided to upgrade the machine by adding new components of a cost of 200,000. Please, who can explain this statement and how the treatment will be based on the one we did, the previous one we did? Look at the year end dates and look at the date that they did the upgrade and tell me what the treatment will be, because I want to know if what I'm teaching is sticking. Yes, I don't want to be talking plenty. You've done a lot of work, so please.
Okay, so
Thank you.
hello.
Yeah, thank you. We are listening.
Please, can you scroll down your and the answer? I'll use it. No, not this one. The answer.
This one
Yes. So
here.
yes. Come down small.
Like this. 2017.
I want to see the 2017 calculation.
2007.
Yes. So my understanding is that as of September 2007, there was an upgrade of a new component of cost, which was 200,000. So my understanding is that it could have, for the depreciation for 2017, we will have prorated by the 10 months or 9 months as up to 31st or 30th September 2007. And then we'll have calculated for, after the upgrade, we'll have calculated a new depreciation for it, for the 2 months.
Okay, so you are right in what you said. Just one thing. This one, there's no proration. This one, there's no proration. You are confused because the year was not ending on December. Now, let me show you one thing. If the year ends on, let's say, June, the next period will start from what? July. So here, the upgrade happened in 2007, although, but it was 1st October. But the year end is what? 30th September. Meaning, as at these dates, we've already prepared the financial statement for 2007, because this happened immediately after the what? 2006 to 2007 year. So this, let me use this one, maybe you understand it well. So for 2006, okay, for 2006, let's say they started the business on 1st October 2005. It will end on what? 30th September 2006. That's what we have. Now, 2006, the same 2006, we will start new accounting period. So that one will start from 1st October 2006 and ends on what? 30th September 2007. That is the second year. Now the third year will start from 1st October 2007 and ends on what? 30th September 2008. So as at these dates, as at the date that the upgrade happened or occurred, we've already exhausted 2006 and 2007. So the upgrade has nothing to do with 2006 and also has nothing to do with 2007. Please, is it okay now?
Yes, please. Yes.
So come again with the same answer you gave.
Yes. So it means that the 200,000 upgrade will be added to the balance as at 2017, as at 30th September 2017.
Yes, 30th September 2007. That's all. Yeah, thank you very much. So let's take note of this accounting periods. It's not all the time that you meet January to December. Okay. So as he's saying, we have to determine our carrying amount as at this 1st October 2007. And we know the carrying amount as at 30th September 2007 is the same as carrying amount as at 1st October 2007. Because I said the closing period of the closing figure or the carrying amount for, let's say, a particular period here, 30th September 2007 becomes the opening one for what? 1st October 2007. Okay, so here we have to determine the carrying amount as at 1st October 2007. So we bring our sign. What was it? Yes, cedis. Okay, so now let's cost. Okay, so we want to determine the carrying amount as at 30th September 2007. This one is also the same as what? The same as 1st October 2007. Okay, so the cost of the assets. Now we are not going to use the depreciable one. We are using the original cost, the initial cost, 920,000 here. Okay, 920,000. Now we are determining our accumulated depreciation because as at this date, we have depreciation charge for of what? 2 years, not just 1 year. If it is 1 year, just write depreciation. But if it is more than 1 year, from 2 years going, you term it what? Accumulated depreciation. Now, what are these accumulated depreciations? We have the one for 2006, 180,000, and the one for 2007, 270. So it will be 180,000 plus the 270,000. That will be the accumulated depreciation as of now. So please, what's the answer? 180 plus 270.
450.
450. So what is the carrying amount as at 30th September 2007? And will you all agree with me that carrying amount as at 30th September 2007 is also the same as carrying amount on 1st October 2007, because that's the date that upgrade happened. Will you agree with me?
Yes.
Yes, because that was the closing balance for 2007, and the opening balance for the 2008 one will be this. So now we can add the subsequent expenditure. If it happened somewhere in January or maybe let's say even November, that one we have to calculate 1 month depreciation. But this one is the same date. So this carrying amount, you can just not confuse you. You can just do it 1st October 2007. Okay, or 30th September 2007, because this is the beginning of a new period. This is the ending of the old period. So the subsequent expenditure also happened on 1st October 2007, it was 200,000. So now the revised cost is what? 270. Say 70,000. Okay, say 70,000. Now we have to calculate depreciation because the depreciation we calculated, this one was for 2006. This one was for 2007. So you have to calculate depreciation for 2008 because we want 30th September 2008. So depreciation 2008. You pick our information here. The cost is now, so the cost, you will not use the initial one of 920. You are going to use the revised one because in the previous work we solved, the cost, we use 112. After the subsequent expenditure, the cost that you have, that's what you use to find the depreciation. Okay, onwards, after the subsequent expenditure, the cost that you have, the revised cost, okay, is what you are going to use calculate, and that's what we use to determine the depreciation. All right, so here the depreciation for 2008, the cost will be 670 minus residual value. The residual value, you are not going to use the 20,000 here because already we've used that one. Look at this information. They said that the upgrade also increased the estimated remaining life of machine at 1st October 2007 to 4,500 machine hours, and its estimated residual value was revised to what? 40,000. So this 20,000 was revised to 40,000. So the residual value will now be 40,000 divided by now the number of hours we have in as at that date. We are saying that after the upgrade, the estimated remaining life of the machine was what? 4,500 hours. Multiply by the one here, 850. As I said, this one might be challenging, but this one is very old. You don't see this type of question in the current one. So even if you don't get it, you don't be confused. You solve more of it, and when you get reevaluation, you appreciate it well. So please, up to this point, is it okay? So the cost, revised one, minus the residual value. The residual value, you use the revised one all over the, how do you call it? The number of hours and all that. This one will give you the cost per machine hour in 2008. You see, in 2006, 2007, there was no upgrade. So the cost per machine hour was 150. So just multiply by the number of hours in the year. But 2008, we cannot use this 150 as a rate and multiply by the 850 here because they've changed things. Okay, they've changed things. So what you are going to do is that you have to determine the new rate per machine hour in 2008, and this is how you calculate it. Then you multiply by the number of hours used in 2008. That's the 850. Okay, so please, what's the answer? Depreciation for 2008.
$119,000.
So the carrying amount as at 30th September 2008 will be
551,000.
551,000. But the main question was asking for extracts for income statement and statement of financial position. Okay, so let's prepare the extract. So first of all, P&L extracts. So the year we have 2006, we have 2007, we also have 2008. Okay, now the depreciation will come. So for 2006, it was 180. 2007, it is 270. 2008, it is 119. So that's what you are going to record, 180,000 270,000 and also 119,000. Now, this one will come here. The purchase of 3-year maintenance contracts. Okay. So the maintenance. So for the 3 years, it was 60,000. So it will be 60,000 divided by what? 3 years. So, okay, the depreciation is negative. So you have to put it in brackets. Maintenance tools and expense. So in bracket 20,000. Staff training cost, the one that we didn't capitalize, we will expense it. Staff training costs, they are added to our expenses. So staff training. It was what? 40,000. That one is just in the first year. This one too is an expense. Now, early settlement discount. That one will be discount received. We did cash book. We know discounts received and discounts allowed. So this one is the discount received, early settlement discount taken on the payable amount of the base cost only. So based on this information, who can determine the how do you call it, discount received for me? Hello. They say that on the payable amount of the base cost only is 5% the discount received. So who can calculate the discount received for me? So it's 5% of what? Hello.
1.150,000.
You are okay. So that's your answer. Read the statement again. They said on the payable amount of the base cost only. So you ask yourself, what's the payable amount of the base cost?
920. 840. Yeah.
840. Because the payable amount is not the whole 1,050,000. No. Payable amount is when you've taken the trade discount out. So this is the payable amount. This is what you pay. 840. So the early settlement discount or the discount received will be on the 840. So that one is an income. So 5% of 840,000 will be what? So that one will be received in the first year. That one will be a positive figure. So not in bracket. 42,000. So this is what we will have in the P&L extract. Now let's go to the SOFP extract. That's the balance sheet extract. That one we have 2006, 2007, 2008. Now let's record just the carrying amount, okay? Because we want to move faster, very fast. So the equipment was the non-current asset was what? Equipment. Or let's name it equipment or machine. So please, for the 2006, what will be the carrying amount for 2006? Who can tell me? I want to see something. Who can tell me the figure as what carrying amount or carrying value for 2006? The first year, what will be the carrying amount? Oh. Well, it's like just two people talking on. Man, I want to see something. Carrying amount, or should I say net book value? So what's the net book value for 2006?
920.
Okay, so the 920 is the cost. That's not the current value, or that's not net book value.
720.
720 are close.
It's not 720.
No, please.
Okay.
740.
740. Thank you. So how did you get the 740?
The carrying amount less the accumulated depreciation.
Carrying amount. Cost or carrying amount? Cost.
The cost. The
Uh-huh.
cost.
Yes. So it will be for 2006, it will be the cost of 920,000 initial cost here minus the depreciation of 180. The person who said 720 use the depreciable amount. So you use cost, not depreciation. So thank you. Also, the 2006 will be 740. Okay. What about 2007? Mm-hmm. 2007.
470.
470. Thank you. So it's even here, this one. So what you do is that the cost minus accumulated depreciation. Don't say that net book value for 2007. So you only deduct the depreciation charge for 2007. So you do it 920 minus 270. No. What about the depreciation in 2006? So accumulated depreciation. So you add the depreciation for 2006 and 2007. So as we have here, we added the two, subtracted from the cost. You got 470. What about the last year? 2008. What will be the current amount? 551. Are you okay?
Yes.
Okay. So please give me a few minutes. I'm coming. We will start with depreciation soon. I'm coming.
All right. Okay.
You don't. Yes. So thank you. So depreciation. We've just treated it. No one is going to ask you what is depreciation, what is the depreciable amount. But when I send you the document, just read through. Okay. So depreciation, we know the definition already. Depreciable amount, residual value. Residual value, sometimes they are called what? The scrap value or something. Yes. Useful life. The period over which an asset is expected to be available for used by what? The entity. Carrying amount. You are saying that it's just the cost, okay? Or the amount at which the asset is recognized after deducting your accumulated depreciation and accumulated impairment losses. So you get to impairment, okay? The net book value is the current amount is also the same as what? Net book value. Commencement of depreciation. When do we start to what? Charge depreciation? You are saying that depreciation must be charged from the date the asset is available for use. I've already said this. So I've already said this one. So this one is not really important because when the asset is ready for use, maybe in June, and you wait till September before you use it, it doesn't mean you start charging depreciation in what? December, September. No, you start charging depreciation on the date it was ready for use. So you start charging depreciation in what? June. and depreciation, the formula we know is what? Cost minus residual value over useful life. Then we have various depreciation methods. Mostly we use this one, the straight line. Okay, and also sometimes reducing balance. So the machine hours is what we just did. Okay, the machine hours is just what it just did, and I've been telling you that this one they are not examined. Okay, because the machine hours and the sum of years they get, we don't see them anymore. We just see these two. Okay, so that's. We also have what? Separate component. So separate component. This one, you can have an asset, okay? And maybe within that asset, you have separate components. So we always use aircraft. Or here you can talk about what? A complex asset, the same thing I said earlier. Okay. So it's one asset as a whole, but within it, you are having different separate components. That's having what? Different useful lives and what? Different depreciation rates and all that. So if you have this kind of complex asset, you cannot charge depreciation for that asset as a whole. No, you have to take the separate components and charge depreciation individually. Then after that, you add them. So let's say you have aircraft. We spoke about the interior. We spoke about the engine. We spoke about the body itself. So you have to calculate depreciation for the body, the interior, then the engine. Before you add these three, it will become total depreciation for the aircraft as a whole. You cannot take the aircraft and charge one depreciation. No. Okay. So you read more on the standards, or when I send you the document, you read it, because this one, nobody will ask you that. Okay. So let's look at this particular example, the illustration 10. Okay. Illustration 10. You're saying that an entity purchased an aircraft with an estimated residual value of estimated useful life of what? 20 years. Okay. With no residual value, the aircraft requires significant overhaul at the end of years 5, 10, and 15. The aircraft cost 25 million, and 5 million of this figure is estimated to be attributable to the economic benefit that are restored by overhauls. Calculate the annual depreciation charge for the years 1 to 5 and the years 6 to 10 if overhaul cost is, say, 6 million. So for the 1 to 5, it will be different. 6 to 10, you use the overhaul cost of 6 million. Okay. So the overhaul just means maybe take apart. Okay, take apart. Maybe you have machinery or equipment. Okay, so you take some parts out to repair or do maintenance, but you capitalize only if it will increase the estimated useful life of the asset, or maybe it will increase the productivity of that particular asset. That's when you capitalize it. Aside this, even if it's an overhaul and it does not contribute to their productivity, or it does not increase their useful life, you expense it. But if it increases the productivity, it extends the useful life of the asset, then you capitalize. Okay, so let's look at this particular workings. Okay, let's look at this particular workings. Okay, so this one is illustration 10. Okay, so with illustration 10, we are saying that an entity purchased an aircraft with an estimated useful life of 20 years with no residual value. So the aircraft, the cost is not 25 million for aircraft only. We said that this 25 million, 5 million is for what? The overhauls. Okay, so the cost of the aircraft will be 20,000. Then overhaul will be 5,000. We have million on top. We are just we are cutting off 3 zeros. Okay. All right. So that will be the total cost for 25,000 because the overhaul matched the criteria. That's why they capitalized it. Now, all they need is what? The annual depreciation charge. Annual depreciation charge. So, first of all, let's talk about the depreciation for the aircraft alone. So, depreciation. Aircraft. This is what? 20,000 divided by, we have no residual value. So, we just divide by the useful life. Okay. It's having useful life for 20 years. So, please, what will be the depreciation charge for aircraft? Hello.
1,000.
Then we come to the overhaul. I want to calculate depreciation because it met the criteria. Okay, so that one was 5,000. Then you divide by the 5 years, years 1 to 5. So annual charge will be 1,000. Okay, then the total depreciation charge for the overhaul and the aircraft will be 2,000. This is total depreciation. So this overhaul is what? From years 1 to 5. Let's look at from 6 to 10. The 6 to 10, they said that cost is what? 6 million. So what do you have here? Hello. Please be fast with the answers.
Hi.
1,200.
Okay. All right. So that is just for you to understand the separate component. So you cannot just calculate it as a whole. Let's look at illustration 11. The first one was 10. So this one will be 11. So this one, an entity buys ship. Okay. An entity buys ship. So this one, let's cut off 3 zeros. Okay. I think 3 zeros will be. So, all right, an entity buys ship for 12 million. The ship as a whole should last for 25 years. The ship as a whole is 12 million. It should last for what? 25 years. The engines, however, will need replacing after 7 years. So if the ship as a whole will last for 7 years, 25 years, and the engine will need replacing after 7 years, you cannot calculate depreciation charge for the whole 12 million. No. You have to calculate the one for the engine and the one for the whole the ship, other components. Because the ship as a whole will last for 25 years, but the engine, we are saying that every 7 years you have to replace it. Okay. The cost of 12 million for the ship as a whole included about 1.4 million in respect of engines. So first of all, you determine the engine value. You are saying it's what? 1.4 million. So let's do it 1,004. The ship, other component apart from engine, because now it's not a whole again. We've taken the engine out. So other component. That one will be the 12 million here, 12,000, minus the value of what? The engine, 1,004. You are getting 10,600 for the other component. So you calculate depreciation charge based on these values. So engine, the depreciation for engine will be the 1,004, okay, divided by that one. We are saying the useful life is what, 7 years. The engine life is what, 7 years. What will be the amount? And also the other component.
The
Another
engine is
component,
200.
engine is 200. Other component will be the 10,600 divided by the whole 25 years, because that one there, it can meet the useful life of the ship as a whole, but the engine is 7 years.
That's
So this one,
424.
come again.
424. 424.
424. So after everything, you have to add it to get 624. That will be your total depreciation. Please, I hope you understand. Hello.
Yes.
I hope you guys understand it, right?
Yes.
Okay.
Hello.
So, come again.
Oh, my network breakdown. If you can just explain the last one, please.
Which one?
I mean, okay, so the last one that you did, the ship, other components.
So the ship as a whole is having useful life of 25 years, but the engine will need replacing after 7 years. So that means the engine alone cannot meet the useful life of what? The ship as a whole, 25 years. So you cannot depreciate them all over 25 years. No. So you have to take the engine out. The component of the amount of the engine was 1.4 million. That's 1,004 here. You have to take it out from what? The ship as a whole, because the ship as a whole is 12 million. The engine is 1.4 million. So if you take it out, other component of the ship aside the engine is 10,600 or 10.6 million. So the depreciation will be calculated based on the useful life of the engine and the other component. Now the engine will last for 7 years because they said that it will need replacing every 7 years or maybe after 7 years. So the engine will be depreciated 1,004 or 1.4 million over 8 useful life of 7 years, because that one can only last for 7 years. So you cannot depreciate it using the 25 years. Okay. But the other component, that is 10.6 million, will meet the 25 years. So that one can depreciate it over the useful life of 25 years. So you depreciate engine separately, 1.4 over 7 years. The other component, 10,600 or 10.6 million divided by 25 years. So that's what we did to get this one. Then the total depreciation will be 624.
Thank
So
you.
that's what we have. We are talking about separate components on complex assets. You cannot calculate the depreciation as a whole, although the asset is there as a whole. Here is the ship is there as a whole, but you cannot calculate depreciation for the ship as a whole because the useful lives are different. So I said where you see one asset, we have different components with different useful life, different depreciation rates. Then you have to do this type of workings. Okay. All
Thank you.
right. Welcome. So the illustration 12, that one too is the same thing. That one too is the same thing. But if you want me to explain, it's quite simple. It's quite simple. The first one will be this fuselage or something. That one will be the cost over the useful life. So the depreciation for this one will be, so let me do it. So that one, it will be the depreciation. You want depreciation, okay? Cost 20,000 divided by the useful life, 20 years. So how do you determine this one? What's the amount? We have the undercarriage. And our carriage, the cost is here, divided by the number of landings, okay? That is what? 500 times 150 flights, okay? Times 150, okay? So this one, just match it with the various things here. The engines will also be the cost of 8,000 divided by the number of flying hours, 1,006, times the hours made. Okay, that was 400. And so this one, just match it with the various items. So after all, you add the depreciation here. But you're not going to get this type of question even in FR. So this one is just to explain the separate components. Okay. Now let's go to revaluation. So this is where you have our questions, okay? Because if you understand this concept, even IAS 16 itself, if you understand it, the asset standards and all, borrowing costs, government grants, and all that will not be difficult. Yes. So for now, the standards, assets are having 9, liabilities are having 5, and also the performance, okay, are having, I think, 8 in all. The common ones are 22. Okay. So the performance is where we have IAS 10, the IAS 8, the IAS 33, EPS, operating segment, and all that. The liabilities too, we have share base, financial instruments, and what? So we get there. The asset too, we have PPE, investment, inventory, borrowing costs, grant, leases, and all that. So please try and understand this revaluation thing. Because if you understand IAS 16, trust me, the standards will be simple for you, especially the 9 assets, the 9 standards we'll be treating here. Okay. So we are saying that IAS 16 allows a choice of accounting treatment for property, plant, and equipment. These are cost model and what? Revaluation model. A cost model and revaluation model. So this one is what? The measurement, how you measure, and this terminology is in the conceptual framework, and that one we know as at corporate reporting, we know all those things, recognition, criteria, measurement, and all that. So measurement is, I said that the recognition simply means you capturing that item in the statement of financial position. So if it is motor vehicle, you are adding motor vehicle as an asset in your statement of financial position. Now you write motor vehicle. What amount are you going to write? That is the measurement, okay? The amount at which you measure the asset. So IAS 16 is saying that measurement of an asset. So measurement of PPE. We have initial one. So the initial one, okay, the initial one will be measured at what? Costs. Subsequently, going forward, so the first year, when you buy the asset now, that year now you measure it at cost. If you bought it for 20,000, maybe less the depreciation for that particular year. So if it was 2017 that you bought it, the cost is 20,000. You calculated your depreciation 3,000. You deduct it, you get what? Net book value or carrying amount of what? 17,000. You are done. That's the initial one. Now going forward, that's the subsequent ones. You have the options to choose between 2 models. So the cost model, that one is just this one. That one is just simple. The cost model, no, is just simple. The cost of the assets, okay? Then your accumulated depreciation will come. You subtract it. Then whatever you get is what you are going to represent on the what statement of financial position. Now we have revaluation model. Revaluation model. So this is what we are coming to treat. Was the cost model that we've been doing it. Now, one thing you should know about revaluation is that revaluation is done periodically. Okay, it's not like fair valuation. So when we get to IAS 40, after this, we are going to IAS 40. We will talk about that one is investment property. You know the difference between revaluation and also fair valuation. Okay, because revaluation allows depreciation, fair valuation does not allow for depreciation. So we are saying that fair valuation is done yearly or annually, but revaluation is done periodically. It's not compulsory that you should do it always. Now, depreciation after revaluation. So when you revalue your assets, the depreciation from there, the depreciation you are going to charge will be based on the revalued amount, not the costs. Okay, so this one will be based. So the depreciation after revaluation. So the depreciation after revaluation will be the revalued amount you have in the question. Revalued amount you have in the question divided by the remaining useful life. So don't worry, we will solve question and you understand all what I'm trying to say. So the revaluation model, as I said, the depreciation will be used using what the revalued amount over the remaining useful life, not the original, remaining. That means whatever life left after the depreciation revaluation, that's what you are going to use. Now, we are saying that if revaluation model is adopted, two conditions must be complied with. We are saying these are: revaluation must be subsequently be made with sufficient regularity to ensure that the carrying amount does not differ materially from the fair value at each reporting date. So you understand what I'm trying to say. So if the fair value is different, materially different, so we know what material means in accounting. Okay, when that omission or that something can influence the economic decision of the user. And also the second condition is what? When the item of PPE is revalued, the entire class of assets to which that item belongs must be revalued. So all of these they are reading, but in actual workings, you are not going to see them. But that's the condition they are trying to say. Now, I said that revaluation is not something that every year you should do, but the frequency of valuation depends on the volatility of what? The fair value. Okay. How frequent, okay, or how rapid does the fair value changes? Okay. So if you are seeing here, the more volatile the fair value, the more frequently revaluations should be carried out. Okay. So the fair value, is it changing rapidly? That is volatile. Is it changing rapidly? If yes, it means the fair value, the revaluation too must be done frequently. So the rate at which you revalue your assets,
Bill.
the
Yeah.
volatility of the fair value. Please,
What's
or
that?
someone ask a question. Hello.
Eh?
Read me.
Pass away.
Okay. All right. So this is just reading. Let's get to the calculation steps. So accounting for revaluation. How do you do these things? Restate asset from cost to valuation. So this one is also the subsequent, it's like the subsequent expenditure. So this one too, when you revalue your assets, you are not going to use the cost of the asset to calculate depreciation. No, or you are not going to use the cost of the asset to calculate the carrying amount. This time around, you are going to use the valued amount or revalued amount. So the asset was 20,000. You've revalued it to what? 25,000. The 25,000 is what you are going to use to calculate depreciation after the revaluation has been done. 2, remove any existing accumulated depreciation provision. So if you were having accumulated depreciation provision for that particular asset, when you perform revaluation, you must remove all. Include increase in carrying value in revaluation reserves. Simply put, it means that you are to include the revaluation gain in the revaluation reserves. And the revaluation differences are here. If we talk about revalued amount, it means if you talk about revaluation gain, it means the revalued amount is higher than the carrying amount. Again, carrying amount is the amount that you have in your books, the organization have in its books. So carrying amount, we are saying the cost minus accumulated depreciation. So this is the carrying amount. Okay. So if you have carrying amount of say 20,000 and there is revalued amount of, let's say, 25,000, you've made gain of what? 5,000. This one is called revaluation surplus or revaluation gain. It means the asset has been revalued upwards. Now, when the revalued amount is less than the carrying amount, we say that you've revalued the asset downwards, and that causes what? Revaluation loss. Because if the asset is, say, in your books, carrying amount is 20,000, but the revaluation that they did, they revalued the asset to 13,000. If this happens, it means you've done revaluation what? They've incurred revaluation loss. Okay. Now, this revaluation surplus and loss, how do we treat it? This revaluation loss, this revaluation surplus, how do you treat it? It's simple. We are saying that revaluation gains are recorded in the revaluation reserves. And that revaluation reserves is reported as what? Other component of equity. So when we're doing the console, you see equity, you see under it revaluation reserves, or sometimes you see other component of equity, revaluation reserves. Okay. So if you have revaluation gains, you record it in revaluation reserves and you show it under what? OCI. What OCI means is what? Other comprehensive income. So what it means is that if you are preparing P&L, after getting your net profit, you add other comprehensive income, then you add revaluation surplus. Okay. And we are saying that revaluation reserves that we send to the statement of financial position as other component of equity or as part of equity component, that reserves can never be zero or it can never be negative. It can never be negative. I will explain that. So revaluation gain is credited or added to the revaluation reserves and shown under what? OCI. So if you make gain, you credit it to what? Revaluation reserve account, because revaluation reserves is an equity component, and we know equity are having what? Credit balance. So if you want to increase it, you credit it. That's what it means. But when you incur revaluation loss, or when the asset has been revalued downwards, that one you deduct it from what? The revaluation reserves and shown under OCI. But because the revaluation reserves cannot be negative, sometimes the loss that you have, the revaluation loss you have, will exceed the gain that you have in respect of that same asset. So let's say it's motor vehicle. In a certain period, you got what? Revaluation gain. The same motor vehicle, in another period, you got what? Revaluation loss. And here the loss was greater than what? The revaluation gain. What you have to do is that you go to the reserve, whatever is left there for that particular asset, you take it out. If there are any excess loss, so if then any excess loss is treated or debited to profit and loss account. So what it means is that if there is any excess loss, that one will not be sent to the revaluation reserves as negative, because already we said that revaluation reserve cannot be what? Negative. So if you deduct everything and you are left with zero, you leave there and go and what? Debit the P&L. Debiting P&L means you are adding it to what? Your expenses. Now, subsequently, any revaluation gain is taken to the profit and loss account to reverse the previous loss. Note, the amount treated in the revaluation reserves account is shown under OCI. So let me do some explanation here. I know the steps here, the treatment is maybe doing some one or two things. So let me do it here. So in 2017, you have 3 years. The first year, you incurred the revaluation surplus. You got revaluation surplus of let's say 200 cedis. This is just illustration. I want to explain something. In the next year, you got revaluation loss of 350. You see, the loss is higher than the gain. Now, 2019, you got revaluation gain of surplus of 195. Now, this is what you are going to do. So the explanation or the treatment here, this is what it means. So you have your years here. You have your revaluation reserve. We have OCI. We have what? P&L. So the years, we have 2017. You have 2018, and you have what? 2019. Now in 2017, you got revaluation surplus or revaluation gain. So that one, we are saying that after you've recorded the gain in the reserves, you show it under what? OCI. Nothing will go to P&L because that one is a gain. And we don't add it to the P&L, we add it to the OCI. Sometimes people get confused with this one. You know, OCI is part of P&L statement, but it's not main component of what? P&L. OCI it's on its own. That's why sometimes if you have OCI, you calculate your net profit, then you add the OCI, then you have total comprehensive income. So here we got revaluation gain. So this one was lost. Let me put it in the bracket because negative. Now, in the previous year, in subsequent years, 2018 in this case, you revalue the asset downwards. So it's resulted in what? Revaluation loss of 350. What we are saying is that the revaluation reserves you have here, it can never be negative. No. So in respect of that same asset, take it out. So here the loss of 350, you go to revaluation reserve. What do you have there? You have 200. So you cannot subtract more than 200 because the reserves cannot be negative. So you take out the 200 here. OCI to you go and take out that 200 from there. Now you have extra loss of how much? Hello?
150.
150. That 150 will be sent to P&L as what? Loss. That's why we said that any extra will be treated or debited to or treated in the profit or loss account. Now, in the next year, 2019, the asset was again revalued upwards, ended in revaluation gain of 195. So you go to P&L, you are saying that go to P&L and reverse the previous loss. So you go to P&L. What's the loss there? Okay. We have 150. Here we have revaluation gain of what? 195. So you go there, you take that you pay that cost, okay? The revaluation gain that you're having 195 here, the P&L previously you have revaluation loss of that same asset, not different asset. No, it's the same asset. Now we have revalued apples, so we have a revaluation gain of 195. So you go to P&L. Initially, we had revaluation loss of what? 150. So we go to P&L and credit this amount so that we take it out. So P&L, there will be nothing left. The amount left is what? 45, because it was 195. We've used the 150 to offset the negative the loss that we were having in 2018. So the 45, the extra gain we are having, will be sent to reserve and also shown under OCI. Note this, even if it's motor vehicle, let's say you have motor vehicle and plant, revaluation gain of plant cannot be used to offset revaluation loss of motor vehicle. If it is motor vehicle, then we are dealing with revaluation surpluses and revaluation losses of only motor vehicle. That's why we said the same class of assets in respect of the same class of what? Assets. So please, based on the scenario I did, who doesn't understand? Hello? And whenever there is revaluation, okay, whenever there is revaluation, surplus or whatever, when we are doing the console, we see fair valuation gain, working still, the net asset, we see fair valuation gain. Then after everything, that fair valuation gain, we go and add it to what? The net PP or the tangible asset in the statement of financial position. So whenever there is revaluation, we debit what? Asset with the fair valuation what? Surplus. So here for 2017, the surplus was 200. So you are going to, in that year, you debit the asset. What it means is that you are going to increase the asset figure by what? 200. Then the credit, the corresponding entry will be in what? OCI. OCI. So that's what it means. And also with the revaluation, it's the same as what? The subsequent expenditure. You have to calculate the carrying amount to the date that the revaluation was what? Performed or was done, before you can compare to find your revaluation loss or revaluation gain. Now, let's say you have an asset, you bought it on 1st January 2011. There was revaluation on, let's say, 1st July 2013. You have to calculate the carrying amount, or you have to determine the carrying amount from 1st January 2011 to 30th June, 30th June 2013. Okay, so we are going to use that analogy here. The same thing that we were applying under subsequent expenditure, we will apply it here too. So please, is it okay? Hello?
Hi.
Are you okay with the explanation of revaluation, the treatment of gains and losses?
So far, yes. Personally, yes.
Yes. So even if you are confused, when you are done, you read the notes, you go over whatever we did, you get it. Yes. If you don't understand it, you get PM. Okay. Let's try illustration 13. And I think that was for you. And trust me, just try, because I think I've just explained it to the best of my knowledge. I think everyone will get this one, because this is the lowest form. or this is the lowest someone can explain to you. Yes, because IAS 16 is very important. As I said, if you don't understand the standards, you will suffer going forward. That one is a fact. Because all the knowledge you need, the carrying amount, the revaluation dates, and all that, you need them going forward. Okay. Okay. So let's try illustration. What? Someone should read for me 13. Please, who is reading?
Illustration 13. A company revalues its assets, that's building, and decides to incorporate the revaluation into its financial statements. Extracts from the statement of financial position as of 31st December 2013. We have building at cost, depreciation. Then the building was revalued on 1st January 2014 at 1.4 million Ghana cedis. Its useful life is 40 years at that date. Show the relevant extracts from the final account as at 31st December 2014.
Okay. So this one is straightforward, but the subsequent ones will not be like this. Okay. So you always, two things you must focus on is what? The date for that particular revaluation. So the date for the revaluation was what? 1st January 2014. Then you also focus on what? The revalued amount. And also the remaining useful life, or the useful life of what? As at the revaluation, whether it increased or what? Decreased. Okay. So whether it increased or it remained the same, that one is very important, because that's what you are going to use to determine or calculate depreciation after the revaluation. Now, they've given us the carrying amount already. Okay. They've given us the carrying amount, and this carrying amount is as at when? 31st December 2013.
Okay, yeah.
And I've been saying this is the last day of the period. So is the same as what? The carrying amount for 1st January 2014. I hope you all you all agree with me.
Yes.
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 So the carrying amount that we have, they've already calculated it, so there's no need for us to calculate. It's 1st January 2014. It's what? 1056. The one we have here is as at 31st December 2013, but this is also the same as what? 1st January 2014. And that is the date that they did revaluation. Assuming they did revaluation on 30th June, we have to calculate depreciation up to that 30th June before we can compare the carrying amount with that revaluation, revalued amount. So here, the revalued amount will be our answer here. So revalued amount is what? 1,004, 1.4 million. We are omitting 3 zeros because we're hanging them here. So what's the difference? Are you getting revaluation loss or revaluation surplus?
344.
So is gain or what? A loss?
Gain.
Gain. So revaluation gain. Now the question is saying that we should determine what? Show the relevant extract from the final account as at 31st December 2014. So 31st December 2014, it means that we have to calculate depreciation for 2014. We have to calculate depreciation for 2014. And I said that after revaluation, we use the revalued amount as the cost. So here the revaluation depreciation for this will be 1,004, not the cost of 1,002 here. No, there has been revaluation, and after revaluation, use the revalued amount as your base to calculate the depreciation over. Now, we are not going to use the original useful life. No, you use the remaining useful life or the useful life as at the date of revaluation. And in this particular question, they said that the useful life at the revaluation is what? 40 years. Is 40 years. Yeah. So divided by 40 years.
So that's 35.
So that is 35. So what will be the carrying amount as at 31st December 2014?
1365.
1365. Now we are saying we should show the relevant extract. So let's start with the P&L extract. Okay, P&L extract. Now with the P&L, you have depreciation of what? 35 negative. And in the OCI, you will show the revaluation gain because we are saying we credit the OCI. Revaluation gain of what? 344. Okay, 344.
Yeah, man.
SOFP extract. That's the balance sheet. That one, the non-current assets will be the carrying amount here because we've already determined the carrying amount. We've subtracted the depreciation already. So it will be the building. The asset was building. So it's just an extract 1365. Then the equity side, you will have the revaluation reserve. Revaluation reserve as what? 344. Please, are you okay?
Yes.
Okay. So I think we will end here. And the next time we meet, that will be Thursday. You will start with your depreciation of revalued assets. Okay. So this one we are
Hello.
going to hello.
Yes. So under the assets, we will not use the revalued amount, which is the 1,400.
You said
Under the assets, we will not use the revalued amount, which is the 1,400.
you know.
We use
Okay, so when do you prepare the SOFP? As at when?
at the end of the year.
At the end of the year. And the depreciation, if you record only the revalued amount, it means you didn't consider the depreciation for that particular year.
Okay.
Yes, because this is the current amount that you are going to use. Yes. So please, any question? So I think our next subtopic, depreciation of revalued assets. So you calculate the depreciation before depreciation based on revalued amount and depreciation based on the historical cost. Then you get what you call extra depreciation on revaluation. Then that one, it means we've overestimated our depreciation charge. So that depreciation we subtracted from our profit, you are going to transfer it towards the equity again. So when we meet, I will explain that. Because if the depreciation charge was, let's say, 70, and now depreciation charge is 50, this 70 will reduce our profit, but this 50, because the same income, let's say the income is 100, depreciation is 70 here, you are getting 30 as profit. Okay, profit 30. This place to income is what? 100, depreciation is 50. It means our profit is what? 50. With the depreciation that we have 70, it means it reduced our profits by 20 because that is the original one is 50, and deducted 70. Therefore, we underestimated or we undervalued our profits. And we know accumulation of profits are seen in the retained earnings. So that one, we will calculate something called extra depreciation on revaluation. Then we transfer it from what? The revaluation reserves to what? Statement of changes in equity. Statement of changes in equity. So I'll send you the document to go through. So when you get it, after reading through, just read from depreciation of revalued assets. So as time goes on, after sending this today, when we are done, I think when we meet, you're not going to spend more than 30 minutes here because we will solve just three, 1, 2, 3. Okay, 3 or 4 illustrations. Then maybe the past question. That one we have answers here, so you can go through on your own. Then we move on to IS 40. So please, I'll send this one and IS 40 because you'll be treating IS 40. I think the IS 40 we can finish Thursday and also start with IAS 2 inventory. All right. So on this note, please, are you having any question? Is there any question for me before we close? Hello.
Hello. I don't have any question, please.
Okay. So please, what are the rest?
I'm fine. I'm okay.
Okay. All right. In absence of any question, thank you for today. And I think going forward, we have to move